Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we're going to go through a year-end mailbag where me and Dan are going to answer some of your questions.
Yeah, lots of great questions. And remember, you can email us at feedback@investorhour.com and tell us what's on your mind. That and more right now on the Stansberry Investor Hour. Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. I've got a lot of stuff here. I've got a lot of great feedback. So I just want to dive in because there's so much of it. But we have to start out with Larry B. We must start with Larry B because Larry says, adding Corey was good, but you should have given us more background on the change. Is Dan about to pass away and we need a change? I don't think he means what it sounds like. It sounds like he thinks I'm going to die. I don't think it means that. But he continues. He says, was it driven by some other thing? Seriously, the show seemed personal before, so it's the equivalent of Dan getting married and not telling us who this new person is.
There's a lot I love about this one, for sure. So thank you for writing in. If you know if Dan's going to pass away, first of all, that would be useful knowledge for anybody, especially you, Dan, I would think.
Yeah, I mean, I don't want to know. Yeah. Hopefully, I mean, my mother was 93, my father was 96. May they rest in eternal peace. I'm hoping the genes are going to work for me. So let's just get that out of the way. Second thing, he says, what was this driven by? And really, honestly, in conversations with the show's producer and other folks, I said, I want to make this show as good as it can be, even if it means firing me and getting somebody else. And they said, well, we don't necessarily need to do that, but how would you feel about having a co-host? And Corey's name was at the top of the list, and here he is. I mean, that really is the story.
Yeah, and I was, not seeking this out. You guys came to me, and happy to join and help and do what I can. Still getting used to it, but hopefully people are enjoying it. And I love the analogy of the equivalent of Dan getting married and not telling us who this new person is. It's a good, and I hope it stays personal. I hope you think it remains personal. That's the idea here, I think, to make this two people talking and great interviews and insight and hopefully advice that you can't hear anywhere else.
Amen, brother. Let's get on to Patrick M. And Patrick M. points out something we've actually discussed once or twice. He says, Dan, you're right about the difficulty Alliance members have figuring out Stansberry advice. The conflicting opinions drive me absolutely nuts. So for those of you who don't know, the Alliance is our top tier service where you pay a single, rather large fee. I mean, I think it's like tens of thousands of dollars now. And then you pay a maintenance fee annually, and you get just about everything we publish at Stansberry, almost everything. And if we get a new service that we add to it, you get that. You just start getting it without paying extra. So there's they get like 200 stock picks a year or something. I mean, it's just a mountain of information, and we try to help them, pick through it and figure out what's right for them. But the thing is, Patrick, what you said here, the conflicting opinions. Most folks don't understand, like, Stansberry is not all one voice. There's a whole bunch of us, and we think what we think. We weren't hired to agree with each other. We were hired to do our best and tell you what we each really think. I promise you, you don't want opinions from people who are ordered to agree with each other. I promise you that is not valuable. This is the opposite of that. These are people who are ordered to tell you what their opinion is, regardless of whether they agree with someone else or not. I just wanted to make that clear. And otherwise, I feel your pain, and hopefully some of the measures we take will help you out here.
I would think a good place for people to look, Alliance members, because honestly, this is a lot of my job with the digest, which I write, almost every day. Thankfully, you write on Fridays, so I don't have to write on Fridays. But I read a lot of what is written, as much as I can from the different editors, and try to piece it together in some form or fashion each day. I think if you're managing your own portfolio and trying to figure out how the different recommendations fit into a complete portfolio, I think a good place to start looking would be our portfolio solutions products, which have a fully allocated breakdown by percentage portfolio from a lot of the different publications, not all of them, but a lot of them. And you can get a good framework there as far as whose publication fits with what, or if there's overlap and whatnot. But that's a more broad portfolio allocation strategies. There's several in there that you could use, and they're pulled from all the different publications.
Yeah, those are great products, actually. When they created it, I was like, oh, wow, thanks. Amazing. Because there is way too much information. All right, moving on now to investment topics. Here we go. The first one, it had to be this guy. It had to be Lodevik H., our faithful listener and frequent correspondent. And Lodevik H., I took out 2 emails. He sent me about 5 or 6, and I took out 2. The first one was actually a little video that he sent, and I boiled it down to a simple question. What is the most interesting buy and hold opportunity considering the crisis in Europe? And I think it's U.S. oil stocks. Very simply. If you listen to last week's episode with Rick Rule, he's got a fantastic list of ideas in there. And that is the simple answer to that, in my humble opinion. I don't know if Corey has any ideas.
Yeah, that's a good one. I'm not going to argue against Rick Rule, that's for sure. So it's,
yeah,
I think going into 2023, the theme to me is going to be certain sectors and names within those sectors are going to likely outperform others, which seems simple-minded to say when you say it out loud, but basically comparing it to a bull market where there's a lot of rotation and everything is going upward, this could be a sideways year, maybe a little positive, maybe a lot negative, by the end of it. But in between, there's probably going to be a lot of volatility. So if you're looking to buy and hold, that I guess you would look for long-term kind of good fundamental, stories, and oil, housing is one of those, even though if we have a recession, you would think housing would get hit even more, but they're already down so much that, the downside there maybe is a little bit lower than some others, but oil's a good one for sure.
Yeah, oil. And generally speaking, the U.S. would be a good destination. U.S. dollars, U.S. almost anything. And I'll discuss that another time maybe, but oil is really the answer. The next question from Lodevik H. He says, what do you make of the massive tech layoffs? It seems Elon Musk was the first with Twitter, but Meta as well. I would say it will be good for the world. There's a massive shortage in people with coding skills, so they can find another job pretty easy. You know something? I was thinking about this question. I thought, well, how much of a shortage can there be if all these people are getting laid off all at once? And also, I had the opposite thought, actually, Lodevik. I was thinking, well, how much has the enormous bull market, fueled by the enormous flood of liquidity of the past decade or so, just padded these enormous companies that gush free cash flow so much that They're some of the most, there are probably the most profitable businesses, especially like Meta, not Twitter necessarily, but Meta and, um, Microsoft and all the big, basically software based, well, Apple is not necessarily software, but huge tech companies that just gush free cash flow, more money than they ever know what to do with. And, they just lavish their employees with incredible benefits and incredible work environments. And now they're laying people off. And I'm thinking, how padded up with extra employees have they been all this time? And, what will this really mean going forward? I don't know.
Yeah, that's a good point. I think Mark Zuckerberg a few months ago of Meta Platforms obviously said something to the effect during an employee meeting, like most of you or a lot of you don't need to be here, which you probably don't want to hear. Which, to your point, I think every CEO might feel that way about some people, but to say that on like a conference call with employees kind of tells you where that you might be right about that. A lot of, I don't know, inefficiencies among the tech companies and over hiring and then obviously cutting back now. So those things come and go. We'll see what it looks like moving forward.
So I got to give it to Zuck, though, for just sort of doing it in an employee meeting and not like leaking it to the financial press.
Yeah. No,
he'll just tell you.
I agree. Yeah, that was, I mean, you probably don't like to hear that as an employee, especially if you're one that's not needed, but it makes it'll make you think about yourself, I think.
Yeah. Cringy. All right. So that's what we got for that. Thank you, Ludovic. Always good to hear from you. And next is Robert H., Alliance member Robert H., and he's talking about a Dead Zone presentation that I did. We called it the Dead Zone presentation, and it's really just a presentation designed to try to get you to sign up for our new newsletter called the Ferris Report. And Robert H. says, your Dead Zone presentation is not particularly from the Investor Hour, but I have this email address at hand, he says. So he said, the Dead Zone presentation is a tour de force. However, I wonder if you should take on the stage name of Cassandra. Little bearish in the presentation. I believe you to be right, and I'm putting my cash hoard, etc., where my mouth is. But virtually everyone I discuss investments or economics with believes that this will all be over quickly, as in the first or second quarter of 2023, and then once again to the moon. Hence, I particularly appreciate your consistent calls. Many thanks, Robert H., Alliance member. I'm glad you liked the presentation. I hope you subscribe to the Ferris Report. Of course, you're an Alliance member, so you get it automatically. But I still feel the same way as in that presentation. When I see people talking about, hey, this is all going to be over quick, I feel like they fail to appreciate how much everything has already changed, how much the world has already changed. And I've covered this before. I even discussed it on the podcast here. I've written about it in the digest a bunch of times. And we just talked last week about Howard Marks's new memo called Sea Change, which essentially makes the same point. And for him, the main change was about interest rates. He's a bond investor, right? So that's going to be important to him. But he said he couldn't overstate the tremendous influence of low interest rates over the past 40 years. So we're going from that low, really easing, falling interest rate environment to a tightening, higher interest rate environment. And, interest rates have gone basically from zero. The Fed funds gone from 0 to 4% or so here. The range 4.25, whatever you call it, like with lightning speed, just basically in 1 year. So that's a big, big change. Mortgage rates, they backed off from 7% nationally on the bankrate.com number. But I think the last number I saw was 6.55% very recently. And that's still way above like my mortgage on my house I bought last year in 2021 is like, I think it's 2.8 something, 2.85 or 2.875 maybe. So yeah, I mean, we're at more than double interest rates, just like that, mortgage rates, just like that. The Fed funds soars almost really. And if you look at some rates, like if you look at the bottom of the 10-year Treasury, March 9th, 2020, if I'm not mistaken, and today it's a 10x almost, close to it. The bottom was below 40 basis points in yield, and it's 3.5% or so now. So, this change is enormous, and I think we've only begun to see the changes that are happening all over the world. And when you see things like, I'm writing about this month in the Ferris Report, so it's fresh in my mind. When you see like the Bank of Japan intervening to support the currency, the Bank of England intervening to save the pension funds and support the bond market, which then the currency tanked to an all-time low against the dollar too, the British pound did, in September when all that nonsense was going on. So these are huge things. These are major developed economies that are having currency and bond market crises. Things are different, Robert. I disagree with those folks who say it's all going to be over in the first or second quarter of 2023.
Yeah, I agree with you. Sorry, we're agreeing again. But
oh, darn it. That's not interesting.
I was just reading BlackRock, the world's largest asset manager, published their 2023 outlook last week, and basically saying, in other words, that, it's different now because the Fed is not coming to the rescue, and they really can't while they fight inflation and other central banks too. This is stuff we've been saying for over a year, but for BlackRock, which actually their assets under management are about the same as the Fed themselves, so they have a outsized impact on things like the Fed. For them to come around and be saying this, at least thinking it and acting on that sort of idea as well, is a thing. You have Howard Marks, you got BlackRock, you got these aren't the only people who are seeing this too. I don't think so. Yeah, the more I think about this, and I think about what happened in 2020 with the amount of money that was thrown into the system, like this is going to be a long inflation battle era, whatever you want to call it. Like you can't just double like the amount of money or dollars floating around the United States and not expect some consequences for a long time. Like this is not a 6 months the Fed will pause rate hikes or cut rates again and then inflation's gone. I don't think we're going back to life before 2020. I think this is going to be a different era of, I'm not saying this time is different, which we hate to say. I'm saying like this, you got to be prepared for the context to change. Within that, it's not going to be the same old low rate thoughts. It's got to be a higher rate kind of mindset.
Yep. And the point is exactly that this time is not different. That's what that means. This time is different is, among other things, the title of a book by Reinhardt and Rogoff that makes the point that, when you get enormous mega bubbles in every asset on the face of the planet trading at the highest valuations in all recorded history, like we just went through, it's bad, and it always ends badly. It always ends in some kind of a crisis. And, each crisis has its own little mojo, so you can't just look at the last one and say that's going to happen again. And a lot of people have said that, and they don't realize that if they're saying, well, it's not another 2008, that it doesn't mean it isn't something else.
Right. I thought that too. The bar for crises, if the bar for crises is 2008, it might not ever get back to that point. But it might be worse in a different way. It might be better in a different way. I think this time around, what you really saw, if you could go back to the things that peaked the earliest, you would say tech stocks, the ARKs of the world, and then late last year, Bitcoin. Those were the things at the end of this, fueled by the pandemic stimulus to like final new heights.
Yep.
Especially I think crypto, the more I think about it, and that's the first thing that's gone down too in like crisis like fashion here with SBF and FTX. And you just wonder if the Fed keeps going, what other things like that may be on the horizon as far as, liquidity drying up in certain parts of the
Yeah.
market. This was an obvious one of if we're going with SBF, like obviously things were not what they appeared to be for a very long time. But what about other ones that are even more legitimate? What if there's more legitimate situations where people are just not managing risk as in a great way? And unintended crises pop up. I'm not saying the FTX one was intended, but it was the first one to go. It seems like one of the first to pop because it was just done so poorly. But the operation was so bad. But other things could happen like this going ahead. So that's something I'm thinking about too. I know you wrote about it recently, like burn these disasters into your mind in the digest. I think that was a good way to put it.
And I was trying to find, I usually have like 50 tabs on my computer open at any one moment, and I can't find an article that I just saw recently that discussed a Bank of America report where they said liquidity will make weird thing. Liquidity crises will crop up in weird places or something like that. And it was really, I think, just a statement by a Bank of America analyst that, look, you don't know where the next little blow up or big blow up is going to be. You don't know, but you know it's coming, because when you tighten the liquidity situation in the whole world, when there's less of everything to go around, when there's less debt or it's more expensive or however you want to put it, something gets stressed out. Like, I can't necessarily draw you a straight line from higher Fed funds rate to FTX blowing up. But we know historically that's the kind of stuff that happens those things tend to happen at the same time, right? After a big bubble, if there's inflation in the air and the central bank is tightening, well, what happens? Well, stuff blows up.
Right. Yeah. I'm not saying the Fed directly caused FTX to blow up either. I'm just saying it created the environment for things like FTX to happen, where one crypto exchange CEO can blow up another overnight, basically, because of the volatility and the speculation and like froth in a certain asset. And the Fed can help create those sorts of things. They do. They create bubbles and they create recessions. So
yeah, they do. I found the headline. It was actually from Business Insider. And I'll just read the headline. I won't go into the rest of it. It says the stock market could fall 24% in 2023 as the Fed's balance sheet reduction sparks liquidity risks in odd places, Bank of America says. Liquidity risks in odd places. That's like the best you can do. You don't know. There's no predicting it. It's just odd places. God knows when the next one will be. Good luck, folks. Bye-bye.
Sounds like a bad sitcom. Liquidity crisis in odd places. Yeah.
Welcome to the next episode. That's right. Starring the zany duo, Dan and Corey.
That's a good way of putting it, though. Like, you don't know when these things are going to crop up. You look at, who knows what mortgage-backed securities are actually going to lead to. Where do you follow those through to? So there's a lot to get into there.
And again, if I was going to look around for where something's going to break, given that, mortgage-backed securities were at the heart of the last crisis, I'd probably not look there first. I'd look just in other places. I'd try to find debts and obligations that people don't know anything about. You're not going to find it probably. Most people aren't going to find it. So that's, we always say, prepare, don't predict. And our past guest, Brent Johnson, from several episodes back, says survive in advance, right? You just have to know how to position yourself to survive bad stuff, right? You want to have some cash, you want to have some gold. And people say, well, Dan, but doesn't one negate having the other? No, they don't, because you don't know anything. Yeah. I mean, it's just the way it goes.
I will say one before we can move on to another one, where the next crisis, might come from, and we won't see it. I keep thinking about these buy now, pay later companies and just mechanisms that that can't possibly end well in an economic downturn. Buying a good with the promise to pay it off later in installments. I saw something online the other day, like a pair of jeans was going for $30 on Amazon, but you could buy it in 4 installments. And like, if you need to do that and you're putting it on a credit card, these are small ticket items, but if you think how many people have been using these sort of payment plans and they add up over time, I don't know, something there. If something bad happens, I think those will be included in it. I can say that.
Yeah, I think that's a great one because more generally, liquidity in the year 2022 means debt. It means the ability to finance or roll over or take on new debt. And that's the thing that tends to suffer. And when interest rates go up, well, all of a sudden, people who are good credits, when they were paying 3%, 7, 8, 9, no, forget it. But yeah, great point. Look for anything like what Corey just described that's based on debt financing. Next comes JP. And JP has a simple question here. He says, I hear a lot about stock buybacks and was wondering if the shares disappear, in quotes, as in the total outstanding shares are reduced, or does the company hold them on their books? If a company needs money in the future, it would seem easier to just sell some of the buyback shares than issue new shares, or would that really make a difference? Thanks, JP. JP, you're right the first time. They essentially disappear. They reduce the total number of outstanding shares. They cancel them. They buy back the shares and cancel them and then reduce the share count. That's a mechanical question. I think maybe we'll just move on to the next thing here.
I'll do Charlie Munger and say nothing to add.
Nothing to add. Very good, Mr. Munger. Next comes Alan. And Alan says, Dear Mr. Ferris, earlier this month on CNBC, the billionaire Ron Barone was touting Tesla and predicting trillions in future market capitalization. I was reminded of Ron writing you an email in December 2021, the episode with Bubba Horwitz, questioning/urging you to recommend Tesla. You very clearly and politely refused. Tesla was trading at $350 per share in December 2021. 1 year later, Tesla's below $200 per share. Alan, I do not remember the billionaire Ron Barone writing me an email, but maybe he did. Maybe he did and I just forgot about it. Or maybe I was reading an article. He tends to show up in Barron's a bit, so maybe I saw that or some other news outlet had him. But the real point is, I told you to stay away from Tesla, and now where are we? And I continue to believe Tesla is dramatically overvalued. It's as overvalued as the meme stocks. These things are all trading for enormous market caps relative to. Well, the meme stocks are really, really bad because I think they're zeros, right? They're going out of business and they trade for billions still, even though they're down like 60, 70%, some of them. But Tesla, maybe Tesla will be around in 10 years, but the competition is coming out of the woodwork. And that was the one thing that I always sort of fell back on. There were other issues with the cars and with, how Elon Musk ran the company and all that stuff. And some people even alleged that there was some fraud or something going on. I don't know anything about any of that. I just know that if there's a real demand for these cars, other car companies are going to get in the business. And guess what? They know how to make cars and make money doing it. So, that's a sustainable business. Not, making most of your money by selling, these green energy credits or whatever they're called. I forget the name of them that Tesla was doing so much profit in. Like, that's not sustainable. And it went away. So I still maintain that Tesla's to be avoided.
Yeah, it's been hurting now, especially Elon Musk with all of his Twitter interests too, and it's people are tying the two together and seeing what's going on with him. So
yeah, I wondered recently. He did that poll on Twitter. He said, "Should I leave the?" I forget what the exact question was. It was basically, should I resign as CEO? And 57% of the people said yes. And he said he would abide by the poll. And I wondered how much bearishness on Tesla was baked into that, right? Was it just a place to dump on Elon Musk one more time? Whether you think he should be running Tesla or not, I don't know. And whether or not he abides by that, I think will be very interesting. If he doesn't, boy, is he never going to hear the end of it, right?
Right. I think he's bit off more than he probably wants to chew on Twitter. Although if he's who am I to say? But he's he's doing other things than me. But from the outside looking in, like, what the heck is going on with Twitter these days? It's nuts.
It is. All right. That was Alan. The next one is Alan M., who is a regular listener and frequent correspondent as well. He had a whole long email about this, Alan. I'm just going to put your first statement in there. But he says, Dan and Corey, I can understand you're not wanting to make statements when you don't know the whole story on SBF, but you make it sound like this poor guy might have had the right intentions. Okay, Alan, I know why you're saying this, and I consider this is my fault. I'll take full responsibility. What I was trying to say, or at least even if I wasn't trying to say it, what I should have said and was trying to communicate, there was a specific just comment thrown out by Matt Levine of Bloomberg. And he said something like, if a bunch of smart but, sort of stupid young people who didn't really know what they were doing but thought they were really smart and going to run the world someday got together, but they didn't really like to do accounting work or administrative work or compliance work, and they tried to run a major financial operation. This is pretty much what it would look like. But the truth is, we all know, like, SBF's parents are shady folks. He is a shady guy who donated money, like in lots of money in political donations. And, where'd he get the money if he didn't take it out of FTX, right? And now it looks like money taken out of FTX was kind of, he's been accused of fraud and conspiracy now for doing it. So, I've written about this guy a lot in the digest, and I criticized him heavily. And my ultimate point, I believe, if I go back and read everything, maybe my ultimate point was something like, who would have heard this guy talk for more than like 60 seconds and said, there's no way I'm ever giving you a penny? Like who wouldn't have done that? And the answer is like a whole list of people like Paul Tudor Jones and all kinds of other famous investors. It's unbelievable the people this guy got money
a whole lot
out
of people smarter than me and more experienced than me. But that was the first thing I thought.
But richer and smarter than both of us.
Right. Yeah. This was a question I picked out too from Al M, whose name I recognize from writing into the digest mailbag a lot too. So thank you for that as well. Yeah, I think this was back in November. It looks like when it came in. This was when we were still learning a bunch about what was going on, or trying to learn a bunch about what was going on with this story. And it's still like, obviously he made a lot of mistakes and a lot of errors, SBF, but I don't think his end game was getting charged with fraud in the Bahamas. I
right.
If anything, I thought he probably thought that was a safe place for him to be running this operation.
I know. He didn't start out by saying, let's go, how can I get myself into a rat and maggot infested prison? How can I do that?
But there's a difference between that and also having the right intentions. And so I don't think he had the right intentions either, from a soul perspective. No. Obviously there's a lot of greed and a lot of the fact that he was wrapped up in politics and the regulation piece of it, and that a lot of people are still forgetting that's the part that triggered all of this, because the Binance CEO was basically had enough of SBF trying to push for regulations that would favor him and not somebody else, and really kind of break the soul of crypto, as we said when we talked to Eric Wade a couple weeks ago. Like, that was the real, all the leverage and all the other crap aside, that was the actual trigger point for this. The environment was right for it. The whole operation seems like a mess, but the trigger point was this his like personal gain from it. So there wasn't a lot of right intentions there. But at the same time, I don't think he was
No.
like trying to intentionally defraud. I don't know. It's a weird kind of line. I mean, he should have known what could have happened, and I don't have any real sympathy for the guy, especially going out and trying to spin it afterward, which probably is what ultimately got him arrested.
Right. The way he tells it, I don't believe it. I don't believe that he didn't know. Like, at the very least, if you didn't keep track of this money coming into FTX through Alameda, like, you had to know at some point that it's wrong to use that money to do anything with, except, it's a customer deposit. All it's there for is to do what your customers tell you to do: buy this, sell that, whatever, or, give me my money back, or here, take some more money. Like, that's all those accounts are supposed to do. And he had to know. I do not believe that he didn't know that he was using the wrong money for, crazy crypto gambling trades and possibly other, not so savory purposes.
Yeah, I don't believe that either.
Yeah. Yeah. So, and the other thing is, and one of the points that I wanted to make for digest readers and also for podcast listeners and anybody who will listen to me for 5 seconds about this is to learn to recognize this idea of, I'm going to get rich and do the world some good. I know how to throw money around better than other people, and I'm an altruist and a philanthropist, and I know what I'm doing, and I'm going to contribute to politicians and shower money into other crypto ventures, and I'm going to shower philanthropic ventures with money and be a great altruist. This whole idea is a giant red flag. And in fact, there's even a little bit, much less, I think, of this mojo in Elon Musk, who said, well, part of his pitch is we're fixing climate change with electric vehicles. Dumbest thing in the world. Anybody who thinks electric vehicles will fix climate change, even if you think climate change is an imminent catastrophe, also a really dumb idea. You're just revealing your ignorance. It's a horrible idea. It's ridiculous. You're basically saying, we don't want people to pull fossil fuels out of the ground. We want them to engage in a lot more surface mining and underground mining of every kind of metal that needs to go in. It's ridiculous.
Yeah, it's just moving the pieces around.
Yeah. And it all suffers from that same problem of saying, I know how to do the world some good. I know how to redesign, all of society, all of humanity, great swaths of the global economy. I know how to do it. It doesn't know how to do it. And the truth of the matter is, economies they build themselves, they make themselves, they create themselves. Humans don't create them. Humans are in economies and markets and societies the way fish are in water. And fish don't control the tides or the temperature or the currents or the wind or the waves or anything.
Amen.
Amen, brother. Okay.
We're just living here. There's a lot of things out of our control. Yeah. Certain people try to control more things than others. And it's a wild world. The markets are the world.
It is.
It's not like they're not, you can't control everything. It's just not the way it happens. And nobody wants to be controlled by everything. I mean, people just want to, I think regular people just want to, just have a good day and have some friends and family and move on.
Though I think people do want security.
Yep.
In their personal property.
Enough.
Yeah, but see what I'm saying, they wanted enough to actually be in favor of being controlled in all kinds of ways.
Right. Yeah.
I mean, they vote for ungodly measures. I won't get into specifics, but they voted one here in my home state of Oregon recently, and I thought, oh my God, you just voted to make the world a more dangerous place. Are you an idiot or something? But they did it anyway because they think it'll make them safer. And things that people think make them safer generally don't. They generally just expose them to greater risk, and they don't understand it. So, there's the more people think that they can institute, hard and fast static rules over all of huge swaths of society, the more they screw things up. Anyway, let's get off the soapbox and get on to the next question.
Amen times 2.
Derek writes in, and Derek says, "Hi, Dan. You've convinced me over time to look at free cash flow as a good metric for evaluating a business, but I'm a little confused as to what to compare against it. And surely it must be based upon some measure of the size of the business. Can you help me make this into a valuable metric? What type of businesses might be a poor fit for free cash flow? Thanks, Alliance member Derek." I'll just take this one real quick. It's a mechanical sort of investing question. First of all, it doesn't matter what the size of the firm is, but you're right in your last question. What type of business? Like the poor fit for free cash flow, two of them come to mind off the top of my head. One is banking. You don't look at free cash flow. It's just not a useful metric. It's net interest margin. That's the sort of comparable metric that you want to look at because that's what banks do, right? They borrow, they lend, net interest. Another example is real estate investment trusts who use a metric called funds from operations, FFO. And funds from operations, it's what it sounds like. You just want to get to the cash income from the real estate operations. So what you do is you add back the depreciation and amortization because they're non-cash charges, same way as you do to eventually get to free cash flow. But then you net out the losses on the sales of assets with the gains on sales of assets, and you also subtract the interest income, right? So you're adding back depreciation, amortization, you add losses on sales of assets, subtract gains on sales of assets, and subtract interest income. And that gets you down, and then you do it on a per share basis, and that gets you down to FFO per share. And that is the comparable metric for REITs. Good question. I like the technical investing questions. They're fun. Thank you, Derek. Next comes Stephen H. And Stephen H. has a good one here. He says, "I've now heard or read numerous experts, or at least wealthy individuals who sound like experts, who came out in the last year with predictions of financial collapse, societal collapse, economic collapse. Are you aware of anyone saying things will be just fine? Maybe even people saying they'll get better? Cheers, Stephen."
That's great.
Are you aware of these people saying everything will be fine? I don't know.
No, I'm not. And this was one of my,
No.
We're also going to talk about maybe top 10 potential surprises for the new year in a future episode. And this one crossed my mind. Everything will be just fine because nobody's, at least not a lot of wealthy people wealthy people spouting opinions in the media as we put it here are saying that. But
yeah, I won't name any names because I don't want to put words in people's mouths, but I have heard plenty of people saying things like inflation has peaked. And I've heard other people just talking like, well, the bear market bottom is around here somewhere. There is actually a substantial amount of that.
Yeah, there's
but that, I don't know, that sounds different. The character of this question is like societal collapse, financial collapse, economic collapse. I guess if you're looking for a bottom, maybe you don't think any of those things are going to happen. So maybe they're an example of that. And I will say that the idea that everyone is too bearish, I think that's baloney.
Yeah, me too. We've seen that this year.
Look,
those like sentiment surveys, it's just everybody's bearish and then everybody's more bearish. It's just it keeps going.
Right. I think it's baloney because if you look at flow, fund flows, I mean, ARK is down. The ARK Innovation ETF, the big one, the flagship ETF, ARKK is the ticker of Cathie Wood's ARK Invest company. That thing is down like close to 80%, if not by the time we're speaking 80% from its all-time high in February 2021. And yet, up to this moment at the end of the year here, people have added a net like more than $1 billion to the thing, like $1.2 billion or $3 billion, if I am remembering correctly, because in the first 5 months of the year, I think they added something like $1.8 billion. And they've taken, a couple $100 million out or something like that. So overall, I think a lot of people are buying this dip, and there are people still on Twitter, lots of them, who have kept with this meme stock thing where, they're saying it's all going to the moon and they're looking for the mother of all short squeezes, like they haven't already seen it 3 times. And the fact that AMC, the two big meme stocks, GameStop and AMC Entertainment, the fact that they're not bankrupt yet and that they're still worth billions in stock market value, that alone tells me we're not near a bottom. There's more pain to come in the stock market. In my
that
opinion.
is certainly a signal for that purpose, I would think, because the it's wild. The quicker people get bullish, the more concerned I get that things will be worse next year, because there's certain signals that would suggest that there's a bottom to the inflation part of the market. Like maybe we've hit an inflation bottom. I was thinking about this today. Maybe we've hit an inflation bottom, but the recession bottom, earnings recession, has not happened yet. If that's going to happen, that will happen next year. And so the quicker people have a trigger finger on, hey, this is the bottom, the bottom, the worst is behind us. Like, what are we? Like I said before, this whole story is just getting started. Like the fallout from 2020. Like this is not. We're not going to end things tomorrow and go to 0% interest rates and 2% inflation and move on with our lives to another bubble, like a bubble in 10 years from now. This is going to be a slow slog, I think, for a while. And there'll be ways to make money. Yep. You just need to find them. It's not going to be like throw a dart at the dartboard and make some money. Like I remember 2020, I think at some point, 95% of stocks were above their long-term moving averages. It was like you could literally pick any stock and would have made money on it. And that's what led to this bubble and this the end of the bubble and the downside of it. It's like, of course people are going to think they can make money in GameStop and AMC if they actually were for a while. And now it's
for 10 minutes they were all rich.
And those 10 minutes are up.
Yep. All right. Next comes Holden C. And Holden C says, first time writing, long time listener. Well, thank you, Holden C. And his question is, my clarity on how you feel about Cathie Woods is, as Jack Nicholson would say, crystal.
Crystal.
However, wouldn't you agree that, especially as a person who hates the Fed only slightly less than Ms. Woods, that her point in her letter is spot on? So we need to say that Holden is referring to an open letter that Cathie Woods wrote to the Federal Reserve, I don't know, a few weeks ago or whatever it was. I wrote about it in the digest. I think we mentioned it on the show. And she was writing this letter to the Federal Reserve basically to tell them to, stop raising interest rates. They're ruining everything, et cetera, et cetera. My point about it was that Cathie needs to look at her own portfolio and take care of her portfolio and stop blaming someone else. I accused her of basically blaming someone else for her failure as a portfolio manager. But I would also, thanks to Holden's question here, and I would also say there's another point, and I don't think the point in her letter is spot on, because the point in her letter, there's an underlying point, I think, and it kind of credits the Federal Reserve with being able to control things from the top down simply by cutting interest rates again. And it's like cutting interest rates is some magic panacea that just makes everything better. And what people don't realize, like cutting interest rates down to zero the way they did is what got us into all the crap that is now unfolding. If you don't do that in the first place, you don't get all of this, bear market, worst year in the bond market since 1788, et cetera, et cetera, et cetera. If you don't get the inflation of the bubble, the blowing up of the bubble on the upside, you don't have to put up with the exploding and the popping of it on the downside. So I'm sorry, Holden, I don't agree with that point. I think the Fed meddling is part of the problem. And she didn't say for the Fed to be abolished and get out of the market. She basically credited them with the ability to make it all better by lowering rates. And I totally disagree with that.
And she doubled down on this a couple of weeks ago on with her Twitter comments, right? I forgot exactly what you said. What did she say exactly? Something along the lines of the Fed, now they're over-tightening and something like that.
Yeah.
Again,
it was more of the same.
Like what? Where was she saying when rates were, to your point, what was she saying when rates were zero for zero rate interest policy. Like,
Exactly.
where was she then?
Exactly.
Yeah.
She wasn't saying, hey, don't lower rates, you'll inflate everything. She was saying, hey, aren't I a genius? Because my ARC fund is up like 300% in 2 years. Well, whatever it is. I mean, it's
Right. And like, she's a portfolio manager. I'm not. But at some point, you gotta just show some like respect to people who are putting money in you, and be able to accept some responsibility, some accountability. But maybe that's too much to ask.
That is too much to ask. Yeah, as we're finding out in many cases, that I feel like my Friday Digest have become like a mission to expose all those people. Yeah. So let's move on here, because the next question is from Aussie Stu from Down Under. I love Aussie Stu. He writes, he's a very thoughtful guy, writes great questions. And he says, "Good day, Dan." And Stu, I chopped your question all up because it's kind of long. So I just want to kind of get to the good parts. And you said, "Good day, Dan. I had some questions regarding the last episode with David Cervantes." This was a few episodes ago. He said, "David mentioned many issues: the housing market's rising costs and issues, inflation, economy slowing but strong, earnings falling, etc. If that is the case, what was the 20% or more drop that we went through in the stock market? Aren't markets forward looking? Have they not seen what you and David and others are seeing on the horizon? Also, are we simply looking at years for all these problems to wash through the system and therefore find the bottom of the bear market? Love if you could explain all that a bit more." This also leads me to a question about energy. Many Stansberry analysts are very bullish on energy. So would energy stocks continue to rise in this possible bear market scenario, or fall like all the rest? I'm really a bit lost in this market. It's really crazy. Thanks, Dan. Great content and guests. Keep up the good work. Aussie Stu. A lot to unpack. Let's just take this one at a time. So on the point about how far stocks have already fallen, and bonds, frankly, aren't markets forward looking? Have they not seen what you and David and others are seeing on the horizon? Well, they've seen some of it, right? But Corey, I bet you have a thought on, are we simply looking at years for all these problems to wash through the system and therefore find the bottom of the bear market? I mean, that's part of your consistent message, is it not?
Right. Yeah. And to this question specifically, I would just say throughout 2022, there's been hope that things would be over and that the Fed would pause rate hikes, even cut them. People forget that. People were saying, "Oh, by the end of the year, they'll be cutting rates." Like, that obviously has not happened. So my point is, every time the Fed has one of these quarterly meetings where they project out economic projections, and for growth, for inflation, for unemployment, every time they've come out with one of those, the market has reacted violently to the downside, the last two of them, because the Fed has indicated that they're going to raise rates higher, and unemployment might go up, and the growth's going to slow down. So yeah, the market's forward looking, but there's also a large part of the market that is waiting on that Fed outlook, adjusting to that as the year goes on. And that just happened again.
Yes. And believing in it.
And believing in it, which is a whole other story. Like, these things, they are, and even, to be fair, Jerome Powell says, "Listen, we've been changing this all year. Like, but this is what our best guess is at the time." And so enough people in the market go with that at the time, instead of thinking for themselves. A lot of people, honestly, I know a lot of people aren't individual investors either, who have the ability to make your own decisions, which is what I like about what we do at Stansberry, and our readers have the ability to do, is like, figure out your own goals. You're not beholden to any stakeholders, and wherever it may be. So my point is, a lot of this is in the market, but there's still reactions based on more recent events than you would think. That those Fed projections are just one example. The next one comes out in March, so there's a lot of time between now and then. But I wouldn't be surprised if there's rallies and and pullbacks until then, and then we'll see you again in March.
Yeah, we'll see you in March. Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. but they worry it's about to get even worse. And many of the things you take for granted are due to a big disruption in the months ahead. Your Social Security benefits will likely be slashed, your taxes are probably going way up, and many of your investments are likely to continue falling, meaning if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning totally free today. It's all spelled out in a free report we've put together about the great unraveling. Get the facts yourself. Go to www.2023unraveling.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's www.2023unraveling.com for a free copy of this new report. Actually, Corey, that's my list of questions, by the way.
Okay. You
In the mail.
You covered a bunch of them there, including all the ones I pulled out. The one other one I pulled out, I just want to maybe comment on from Bob J, who a few weeks ago, the episode with Eric Wade, who he said the comment by Corey McLaughlin about U.S. banks is actually laughable considering their behavior during the subprime mortgage fiasco. So let me just clear that up. I was actually trying to make a point that what happened in crypto could happen anywhere, and that maybe it wouldn't happen at a bank, but maybe it would. Like that was basically it, and I wasn't clear enough saying that. And Eric was kind enough to point that out to me during our interview with him, and that's that. Basically, what happened with FTX and SBF, I think in some ways it was specific to the crypto world, but in a lot of ways it wasn't.
Well, Eric is passionate.
Yeah, I would agree with that.
Passionate guy, and he knows what he's talking about.
Correct. So. Yeah. So I just wanted to clear that up since I'm a newbie here and don't want to be making anybody think that I'm in love with the bank system and everybody in it.
So now that we've gotten through our questions, like maybe I should turn my final interview question on both of us. If we had to leave the listeners with a single thought today, what might yours be and what might mine be? And I have to say, I just thought of this now as we're recording in the moment. And so I'm totally unprepared for it.
As am I.
And I'm sure you are too. Yes.
But I like it.
But is it cowardly for me to ask you to go first or not?
No, just let me gather my thoughts for a second. I would just say, know thyself in terms of your goals and what you want to do with your money and why it's there in the first place. You know, a lot of stock pickers and market analysts won't even come up ever. But I think that's the thing you really need to start with, and then it'll make a lot of decisions easier from there. You know, like, are you relying on your money to live on next year, or are you not? Meaning, are you retired and living on a fixed income and don't want to lose 20% more of your nest egg in a bad recession? Or are you really long term? Are you on the younger end and can afford to take on more risk and stay invested and compound and all those good things, 10, 20 years, 30 years, 40 years, however long people live nowadays. If that's the case, yeah, I hate losing money. I would hate losing 20% on anything. And I've been really conservative this year since the beginning of this year, protecting what I have. But at some point, you also need to think about what comes next, and to think about what your goals are will help you make decisions to that. So that's probably a general kind of thought, but I think it's one that it's not said enough.
Yeah, as soon as you started talking, I was nodding my head and say, yeah. My comment is maybe like a subset of that. It's a portion of that. And I would say, knowing yourself then involves one very important skill that too few people have, which is the ability to admit all that you don't know. Too many times in life, we find ourselves in situations for one reason or another one doesn't feel one is permitted or one is absolutely not permitted, to say, I don't know. But what you don't understand, in a world awash in information, an Amazon river of information coming at you 24/7, relentlessly, just a fire. You want a sip of water and it's a fire hose in your face 24/7. It's horrible. In a world like this, saying I don't know is knowing. That is, in a more primitive world where, like, we're just figuring out fire and you're the guy who knows fire, knowing is everything. In this world where it looks like anybody can be made to look like they know a lot and they really don't, being the one who is honest and admits all that they don't know is hyper important. And that is the equivalent now of knowing how to make fire. And that's what you got to do. That's how you're going to position your portfolio, because all the people who bought garbage and held on to it, all the people buying the dip in ARK and meme stocks, they think they know, but they don't. They thought they knew just because they were rich for 10 minutes, and they say, well, I'll be rich again soon. I'm just going to keep buying. No, they're not. They're going to go broke. They're going to lose all they have in those stocks anyway. And that, you see the difference there? That is what you have to do. That's why I say prepare, don't predict. And I sometimes repeat our previous guest, Brent Johnson's advice to survive in advance, right? That's why I say hold plenty of cash, and also hold gold, and also hold stocks, and also maybe hold some real estate. And if you're an expert in some kind of other asset, hold some of that too, of course, because that's what you do when you admit. That's the kind of portfolio you wind up with when you admit that you don't know all that you don't know.
Well said. You don't know what you don't know, which is a problem for a lot of people too. So,
yes, right. All the things you know that you don't know, then the things you are unaware that you don't know. There's a lot you don't know.
There's a lot,
and you got to figure out how to prepare for it. Yeah. All right. Well, it's been a pleasure discussing our mailbag with you today, Corey.
Yeah, I enjoyed it, Dan. Thank you. It was my first edition here, and fun to speak directly to the listeners.
Yeah, maybe we'll do this again soon. Maybe in another month or 2 or 3 or 4, however long we need to wait to get a nice long list of questions like we had today. In the meantime, that's our mailbag for now. And that's another episode of the Stansberry Investor Hour, too. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note, feedback@investorhour.com, or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.